All right, good afternoon, everybody. Give me one moment to get my screen set up so I can see the chat. Hopefully y'all can see me and hear me just fine. If somebody can shoot me, we can see and hear you just fine, John, into the chat. I would appreciate it. And we will kick off and get started. Perfect. Thank you, Marlene. All right. Good afternoon, everybody. Thanks for joining me. I'm going to dive right in. I've got a lot to cover, and my goal today is to really cover the big picture of what you need to know. By the way, I think you can't see me. Maybe you can. Can you guys see me as well? You can hear me. Yes, you can see me. Love it. All right, I can't see me. That's okay. I don't need to see myself. All right, so I want to talk about a lot of things really from the perspective of, as a realtor, what challenges do you run into with clients that they either opt out on their own and they say, hey, I don't want to try and buy a home because I have these problems and somebody else has told me no, or B, they don't even want to try because they're afraid that they can't get it done. And C, if you got a deal that's falling apart and we need to save that deal, these are some options that we can save some deals. There's a lot to this. I want to stay really, really shallow and give you a good idea of some of the problems that we can solve. The easiest way to explain how these products work, it picks up where Fannie Mae, Freddie Mac, conventional loans, as well as FHA and VA loans leave off. So FHA, VA, Fannie and Freddie have certain criteria. Those are always going to be the preferred way to go. Every time you send a client to me, I'm always going to cover those products first. But if they don't qualify for those products, I'm going to give them two choices. We can set a game plan for a future point at which you do qualify for those products, or we can use one of these alternative products now. It's just going to be a little more expensive, and let them decide. Because we're in a position right now where there's a lot of pressure on interest rates to go up. And with that upward pressure on interest rates, somebody might pay a little bit higher rate today, but in return, they're probably going to have a lower rate than where the market's going to be. If inflation keeps going the way it's going right now, we could see interest rates go up pretty significantly in the next couple of years. Now, I don't really see that happening. I think inflation is going to kind of temper itself out, but I think 2022 is going to be a crazy year. The Fed just made it super clear yesterday that they're very concerned about inflation, and they're going to start raising the prime rate in the middle of the year next year, and that's going to put pressure right now on mortgage rates to go up. So that's enough about rates. Let me dive in and talk about kind of what these products do. What we're going to cover today is the 4 parts to a loan and how I help solve the problems on those 4 parts. So I'm going to give you an overview of what the 4 parts to a loan are, and then we're going to talk about what issues clients run into regarding cash, regarding credit, regarding income, and regarding the property. So let me get my handy dandy little pointer so I can, yeah, you can see where I'm pointing now. Okay, so let's dive in. What are the 4 parts to a loan? Cash. Now, cash itself is a 4-letter word. Be super careful when you have buyers. I think you all know this, and some of you are probably screaming at me right now, John, cash is not okay. It is not okay. So green pieces of paper with pictures of presidents is never okay. But when I say cash, I'm talking about the money in the bank, the funds you have for down payment, closing costs, and reserves. The second thing we care about is credit. That's your credit score and major derogatory credit events. Credit is how well you paid your bills in the past, because it's the best indicator for a bank on how well you're going to pay your bills in the future. The final piece is income, type of job, length of employment, stability of income, method I'm using to document that income, and maybe some down years that you've had, 2020 COVID being a good example. Those are all things we look at when we're calculating income. Income is a yes or no question. Unlike credit, where there's a shades of gray that say, hey, if you got low credit, you're going to pay a higher interest rate, but we can still do it for you. You have higher credit, you're going to get a better interest rate. Income, no matter what your credit score is, if you don't have enough dollars coming in the door, then you won't be successful in making the mortgage payment. So that's where income is critical. You either qualify or you don't. And then the last piece is property. That's the value of the property, the condition of the property, and the property type. For example, condominiums, the actual condominium project needs to qualify as well. So the thing I want to make super clear, I actually talk to a lot of your clients when you refer them to me, and I specifically explain that, hey, the first 3 things can offset each other. So if you have a problem with cash or credit or income, I can typically find a solution with a regular loan, conventional Fannie Mae, Freddie Mac, FHA, VA. If you have a problem with 2 of them, now we're getting into deeper trouble. You got a problem with all 3, we're going to be in really deep trouble. property has to qualify on its own. So if somebody says, hey, I've got huge amount for cash, credit is great, income is great, but this condition of the property is unlivable, but hey, I'm buying it as is, are you okay with that? The answer is no. Our conventional loans don't allow us to buy a home in as is condition, even though the seller says as is. We have to make sure the property is safe, habitable, and has no issues with health and safety. Now, a couple of solutions to this as we move forward, and I'll explain it right now. I am going to pause at each one of these sections to see if you guys have questions. If you do, I'm keeping an eye on the chat, and I'll respond to it via chat. If you're watching this on YouTube or as a recording later, just post it in the chat, and I'll follow up with you after that. So seeing no questions in chat, I will go ahead and move on. Programs to overcome issues with cash. The first thing is limited down payments. That is the number one thing holding people back from buying a home. People are renting and rents are super expensive. They can't save enough money for a down payment, and that stops people from being able to buy a home in today's market more often than not. Now, our new products, they don't solve that problem. As a matter of fact, all of my new products require at least 10% down payments. By the way, the new products also work for refinancing, so as long as they have 10% equity in the property. But I want to remind you, I have a bunch of down payment assistance programs. I've got down payment assistance that can help cover your down payment, portions of your closing costs, and you don't even have to be a first-time home buyer. So although I won't talk about down payment in this webinar, I want to make it clear we have a lot of options with down payments. But let me go into some of the things we do to help people with small down payments. This is one of my new exciting programs, is my medical professional program. I am super, super excited about this program. It is designed for medical professionals. So you can read the list right now on who it is. Basically, it's residents, MDs. It can be a dentist. It can be a podiatrist. It can be a veterinarian. So what it allows is overcoming the issues that doctors have, especially newer doctors, which is they don't have a lot of money saved up for a down payment, and they typically have a sizable amount of student loans. This medical professional program is designed to be a temporary loan. So it's not a 30-year fixed rate loan. They're typically a 5-year fixed rate because they're going to be in a better financial position 5 years from now, paying down student loans, having more equity in the property to refinance out of this. So that's the one drawback of this program. It's the only program you'll hear about today that doesn't allow for a 30-year fixed. Every other program does allow a 30-year fixed. But the cool thing about this is they can buy a home up to $750,000 with 0 down payments and no mortgage insurance. And they can go up to $850,000 with just 5% down. Again, no mortgage insurance. And the biggest thing for a lot of these doctors is their amount of student loans. We can ignore student loans as long as it's deferred or in forbearance for at least another 12 months, okay? Another area that we have problems with limited down payment is jumbo loans. And I have some solutions to the small down payment jumbo loans now. What you're looking at is one of my new programs. I can do a jumbo loan up to $1.5 million with only 10% down. So if you think about that, somebody could buy a $1.5 million property, put $150,000 down payment, and I'm going to loan them $1.35 million. That is unheard of at that level. So when you have somebody that says, hey, I'm trying to buy a home and I have a small down payment and I'm doing jumbo, I'll go up to a $3 million loan with just 25% down. So I've got some really, really good options. And the cool thing about this program is this program actually meets Fannie Mae's guidelines. If you've done any work with jumbo buyers, you know jumbo loan programs have more restrictive guidelines than Fannie Mae. I, on my new program, say, hey, if it meets Fannie Mae's guidelines, then they meet this jumbo loan guidelines. So if you have somebody that said, hey, I qualified for conventional, but my lender's telling me I don't qualify for a jumbo loan, with very few exceptions, I can qualify anybody that qualified for conventional to also qualify for a jumbo loan. And actually, I should say that loan to value you just talked about, 10% down up to 1.5 million. That's for the people who have the same guidelines as Fannie Mae loans. This product I'm talking about right now is a different product. I'll actually do a 10% down payment up to a $3 million loan amount. So somebody can buy a $3 million home and only put $300,000 down on it. So there's a lot of flexibility here on jumbo financing that hasn't existed in the market until now. So Penny, will you making the PDF of the slides available? I would be happy to. I'm not sending them out. Let me say this. If you want me to give you a PDF of the slides, then post in the chat and I'll give me your email and I'll happily send you a PDF of the slides. Just recognize this isn't marketing material. Like I can't give this to you as you providing it to your clients. Like if you want to read back through what I gave you, no problem. I'll actually have the recording also on YouTube so you can watch it there again if you choose. But I can't have you using this as marketing material showing clients. And I also can't have you looking at it saying, oh, well, hey, this person's going to qualify, because there's a lot of other rules that I just did a little snip on there. All right, perfect. Thank you, Beth Arthur. Beth Arthur? Yeah, there's like 4 Beth Logues here. So cool. All right, let's go to the next one. Any questions about any of the cash programs or the cash solutions where I can help people with small down payments? No? All right, feel free to post into chat anytime you have questions. I'll make sure to catch them as we go through. So now let's talk about credit issues. We have a lot of people who have credit challenges. The biggest credit challenges being bankruptcies, foreclosures, short sales, deed in lieu of short sales, et cetera. So I want to point out Fannie Mae, Freddie Mac, conventional loans, FHA, VA, and USDA. They are pretty forgiving in a lot of these categories already. So a conventional loan can do a bankruptcy anywhere from 2 to 4 years after the bankruptcy. And they can, an FHA loan can do 2 years after a bankruptcy. So there's a lot of wiggle room within the guidelines for people who have credit challenges without having to step into these alternative programs. But there are people who don't meet those programs. And this is where my New Start program comes in. My New Start program will allow somebody to purchase or refinance a home 1 day after they've had a bankruptcy, foreclosure, deed in lieu of foreclosure, or a short sale. That's huge, because you might be thinking, John, why in the world would you guys want to loan money to somebody that just lost their house? You'd be surprised how many people have co-signed for a family member and that family member lost the house. They are a good credit risk. They've still got good credit scores. They've got a good down payment, but no bank will let them buy because they have a foreclosure because they made the mistake of co-signing for a family member. This program lets me use that option to get them qualified right away. I want to be super clear about the rates for these programs. They're definitely higher than the interest rates for conventional FHA VA loans. Right now, what you're finding for traditional conventional FHA VA loans are rates between 2.99, depending upon the day, if it's a good day, up to about 3.5%, maybe even 3.75, depending on if it's a bad day. With these programs, the lowest rates might be at 4.25. The highest rates might be at 5.9%. So it's definitely higher. Don't misunderstand. There's a cost that comes with this, but that cost is small for the person that otherwise can't buy. And it's way cheaper than what you would pay for a hard money loan. So it's a good in between for that person that, hey, I can't meet these guidelines. I don't want to wait. I need to do something now. I'm willing to pay a little bit higher interest rate in the short term. Most of these programs, except the medical doctor, are 30-year fixed. None of them have a prepayment penalty. We're not trying to do predatory lending. We're not trying to do it the wrong way like we did 20 years ago. We're trying to do it with precision. We're trying to do it appropriately, and appropriately really means that you don't have to worry about your rate going up. You don't have to get locked into the loan with a prepayment penalty. One of the other things that we are now able to do with some of these programs is to use the FICO score of the person that makes the most money. If you know how lenders look at credit scores, you know that if you have 2 people on a loan, I have to take the worst scoring borrower. But with my new programs, I get to take the credit score of the person that makes the most money. So you might have a husband and wife where the one person has a credit score of 750 and the other one has a credit score of 550. With normal loan programs, I'm in trouble. I can't use the income of the person whose credit score is 550 because I can't put them on the loan. They don't meet guidelines. With my new programs, even if their credit score was 450, I only care about the credit score of the person that has the most income. So there's opportunities where somebody is told no with another bank, or told no because they came to me first. By the way, I'd love to help you out with everybody that doesn't qualify with a different bank, but it's a much smoother process if you refer them to me first, because then they're only talking to me. I'll go through all the options for the regular loan, and if they don't qualify, I'll immediately say, hey, here's your game plan to qualify for conventional, or here's your option to qualify today. So primary wage earner is really big. For the low credit score clients, we definitely require full income documentation. I'll talk in a few minutes about ways to overcome income challenges, but you cannot use those with somebody that has the 1 day out of a bankruptcy or foreclosure. So just understand, I'm not going to do alternative proof of income and somebody has super negative credit issues. And that's where you'll notice at the bottom of every single slide, it says not all features mentioned will work together at the same time. That's part of where I want you to be careful as you are digesting this information. I don't want you telling clients you will qualify. What I want you telling clients is that your concern that you won't qualify, that you don't qualify, might not be true. I have a guy. I'm going to have him call you. Here's some things we do to make sure they succeed. We look at things like residual income. Residual income is how much money is left over from their take-home pay after paying their house payment, credit cards, car payment, because we want to make sure they have enough dollars to afford their bills. We look at payment shock. If somebody's currently paying $1,000 a month and they're using one of these alternative programs, I'm not going to let them qualify for a mortgage at $3,000 a month. We want to make sure that they're used to paying a payment that isn't too far off. I don't need you guys pre-qualifying people asking them what they're paying now in rents. I'm just giving you an example of how we're paying attention to make sure these programs are done correctly and that we're not setting people up for failure down the road. We also heavily look at reserves. So reserves being the money that you have in the bank after you pay your down payment and your closing costs. All right, give you an example of the New Start program. If somebody had, again, a foreclosure or bankruptcy yesterday, I can do 20% down as long as they have a 720 credit score, up to $1 million. So I can do a jumbo loan with 20% down if they have good credit. And if they have bad credit, I can still do a jumbo loan for them. They just need a much bigger down payment. So you can see when I say we're paying attention and doing this smart, that when you have really bad credit issues, I'm going to want a bigger down payment to offset if you have a lower credit score. If the credit issue still left you with a good credit score, I just need a moderate down payment. No penny, these don't change by county. So this is a non-government backed program. So all of these loan limits are across the nation. So this is applicable everywhere. And for a lot of my clients, we end up doing cash out refinances for this. Maybe they're looking to buy an investment property. Maybe they really need money to pay a major bill, or they just got themselves in trouble and they got a lot of debt they need to consolidate. I could do somebody with a bankruptcy yesterday that is doing a cash out refinance with a 600 credit score. I just can't loan them more than 60% of the value of the home. So again, there's trade-offs, but there's huge opportunity here. Most of these people would be going to a hard money lender and paying 8, 10, 12% interest rate. I'm going to be at, for this kind of a client, 5.5 to 6% interest, way cheaper than hard money lending. Okay. When it comes to jumbo products, we have kind of a waterfall of thinking about jumbo products when it comes to credit. You start at the top, you're going to get the best interest rates at the top, but it's hardest to qualify, and those are the big banks. So a big bank is going to have requirements that you've never had any credit events ever. Wells Fargo is one of the biggest jumbo lenders right now. I loan Wells Fargo's money. The cool thing is I'm not a bank. I have 7 different jumbo investors that I use that allow me access to their guidelines and their money. If somebody goes to Wells Fargo, they only get Wells Fargo's guidelines and they're told, nope, you don't qualify because you don't meet our bank's rules. I have the waterfall. I can give you Wells Fargo's guidelines, or I can move down the waterfall. You've got real estate investment trusts and insurance funds. They have varying degrees of restrictions that are greater than Fannie Mae's loans, but they're not as tight as what the big banks are. Then I've got this new product I mentioned that is my jumbo, what's called AUS or automated underwriting system. It matches Fannie and Freddie's guidelines. And then I can go one step further, which is my expanded access program. Excuse me, my frog has come back to my throat. And that lets me do a loan, a jumbo loan for someone with as little as 2 years since a significant credit event. So this is where I like to say, I am very well suited. Excuse me. I am very well suited to take great care of your clients, regardless if they are in the perfect credit situation or far from perfect. I have programs that can match any of their needs. Questions about how I overcome credit challenges? All right, nothing. So means I'm doing an amazing job. All right, so I want to talk about how to overcome issues with income. It's one of the biggest problems we're dealing with right now. Self-employed people, we are struggling to qualify them given the challenges that happened in 2020 with COVID. And I mentioned it last year. If you followed me at all last year and you listened to my weekly webinars that I had done about what was happening with COVID and how it was impacting the mortgage industry, I said, guys, the hangover from this is going to be a couple of years, because the self-employed people that had to close their business in 2020, guess what? The tax returns they have right now, December of 2021, the only taxes they have are their 2020 taxes. And those 2020 taxes look horrible for many self-employed people. Fast forward 2 or 3 months, we're going to have people starting to file their 2021 taxes. But most loan programs require 2-year average of tax returns for self-employed people. So that means that we're going to have a better 2021 for most people, but we still have to show 2020's taxes. It's not until spring of 2023. So we're talking a year and a half from now, before somebody's going to have 2 years of taxes that does not include 2020. That's a pretty long hangover for self-employed people to be able to qualify. So what I've got is some options that take away the need to have the 2 years of taxes and the 3 months of bank statements. One of my options is 1 year of tax returns. And here's the cool thing. I can average the year-to-date P&L income into that 1 year of taxes. So when somebody says, hey, last year I made $100,000, but this year I'm on track to make $150,000. I can average those two together using last year's taxes and the year-to-date P&L. and say, great, your income average is $125,000. So we have the option to use your P&L and count towards improving income. Excuse me for a second. All right, sorry about that. So that's one option. The other thing is I'm really good at helping people navigate taxes. I actually grew up in a tax household. My dad did taxes forever, and I helped him as an indentured servant of a 12-year-old son. I was helping him to fill out tax returns, and so I know them very, very, very well. One of the things I do for a lot of my self-employed clients, this time of year especially, is to give them advice on how their taxes should look before they file them. Don't misunderstand, I'm not giving tax advice. I'm telling them, hey, in the spring, when you go meet with your CPA, have them complete your taxes, but don't send them to the IRS. Instead, send a preview copy to me. I will be able to calculate what you would qualify for based on that preview copy. And then I can give you some advice that says, hey, if you just showed a little bit less expenses, if you just moved some money around a little bit here or there, you're going to help your ability to qualify, and they can make those changes before they file the taxes. Once you file your taxes, that first copy is written in stone with the IRS. To change it, you have to file an amendment to your taxes. The amendment shows what it was originally and what it is now. We will never believe an amendment when that amendment makes your income look better. We are going to believe that your income has only gotten better because you needed it to qualify for the mortgage. But we can use that trick of looking at the taxes ahead of time to qualify them for a conventional or FHA loan. For the people that doesn't work, I have another option that's 12 months of bank statements. It allows me to use the deposits over the last year as proof of their income. Well, the last year has been great for many people who were closed in 2020. They're back to work and things are going well in 2021. So especially maybe for people who write off a lot of expenses, the bank statements may be a good way to prove more income anyway, because I can use your deposits instead of your profit. So there's a lot of flexibility using bank statements. It's a great way to help self-employed people qualify. Here's some options for other people who are not self-employed. We can use assets in the bank as income. Now, for the longest time, really since 2011, when Dodd-Frank Financial Reform Bill came out, it was really clear that having money in the bank does not help you qualify for a mortgage. It's income that helps you qualify. And what we're doing now is they're allowing us through these new programs to take the assets you have in the bank and pretend you were pulling out a little bit every month, and we're using that as qualifying income. So if you had $200,000 in the bank, I could pretend that over 10 years, you could pull out $1,600 a month, and that would count as income. That's one way that I help qualify people that have assets, but not income. The best way is trust income. We create a living trust, we move their assets into a trust, and we set up scheduled payments out of that trust. I'm allowed to take the total amount that you have in the trust, spread out only over 3 years. Now that's kind of scary when you think about the fact that I'm giving somebody a 30-year loan, and I only care about the fact that they have enough money to pay it for the next 3 years. I definitely make sure my clients have other income. It's just a Band-Aid to get them through for now. And they don't need to, they won't have the concern about, oh my gosh, John, I've spent all my money. No, all you're doing is moving the money from the trust into your personal savings account. If you want to use that money to pay the mortgage, great. If you don't, no problem. You're just moving the money from one pocket that belongs to you of your trust to another pocket that belongs to you as your personal income. The final thing that we're able to do, by the way, the trust income option, I can use that for regular Fannie Mae, Freddie Mac, FHA, VA loans. So this option comes with the really, really low interest rates. Projected income, that is with my new programs, the higher interest rates, I'm allowed to use income that is projected to be earned over the next 2 years. So think about this, I run into it all the time. Somebody says, John, I've got a new job and I've got pay raises that are scheduled out and I'm guaranteed every 6 months to get a 15% pay raise. With normal programs, I can't use that income. With my new program, I can take the total that they're going to earn over the next 2 years. So, hey, for 6 months it's here, next 6 months it's here, next 6 months it's here, 2 years worth. I'm able to take that total amount of income, divide it out over the 2-year time frame, 24 months, and say, yep, I can count that as additional income. So cost of living adjustments, bonuses, raises, that kind of thing, we can use projected income. Again, the key I want you to remember is somebody who says, man, I got to wait 2 years to buy a house because my union says my income's going to grow by this much in 2 years, but the bank won't let me use that income. I will let them use that income. So great opportunities to help people qualify. The last program, I think it's the last one, that is about income is my investment property program. This one is super exciting and a little bit scary at the same time. What it does is it ignores the monthly debt that you have and the income that you have on everything except the property I'm doing the loan on. So if somebody is buying or refinancing an investment property, all I care about is that the income from rents on that property cover the monthly payments, and it doesn't even have to cover the entire monthly payments. And I can go down to a 620 credit score for this. Now, they got to have good mortgage payment history. They can't have any significant credit events in the last 12 months, and reserves is a really big deal. because we got to make sure they have extra money in the bank. But we can help somebody, for example, if they have $2,000 a month of rental income, that's enough to cover a mortgage payment of up to $2,400 a month. So the property has to come close to cash flowing, but it doesn't actually have to exactly cash flow. This is great for 1031 exchanges. I've helped multiple people with this program where they have a property they own, it's got good cash flow, but they want to trade it out for another property. Well, the income on the properties is not the problem. The problem is that they have no primary job. They're living off their assets, they're living off something, they're living off their kids or mom and dad, I don't know. But they don't, or they are self-employed and they do a good job of not paying taxes as being a self-employed person. They don't have the income necessary to qualify to support their entire portfolio of debts. But this program solves that problem. This program allows me to say, hey, as long as the new property you're buying cash flows, or as I put here, kind of cash flows, then you are able to qualify to buy or to refinance that property. And I don't care about any of your other debt. I don't care about any of your other income. So hopefully that makes sense. All right. This gives you an idea of what the loan to value is. So 20% down if you have a 740 credit score. Somebody who has a 620 credit score, they need 35% down. So this is that program. It's called DSCR, or Debt Service Coverage Ratio. Marlene, does the investment property need to be their primary residence? It's actually the opposite. It's not allowed to be your primary residence. The reason why we can get around proving income, the Dodd-Frank financial reform bill that was passed in 2011 has a requirement that we have to prove somebody's ability to repay all of their debts when I am loaning money for a primary residence or a residential mortgage. But these are considered business loans because you're running a business. You buy an investment property, it's a business. You own an investment property and you're renting it out, it's a business. By the way, we can use these with Airbnbs as well. I'm actually able with a lot of these programs to use Airbnb income. So people who own Airbnbs, Fannie Mae, Freddie Mac guidelines don't like to use Airbnb income. This program does allow me to use Airbnb. Marlene, depending, again, still the same in the 4.5 to 5.9% range of interest rate. So it's not, it's not conventional loan rates, but you're looking at, again, probably, again, this is a higher risk loan. You're probably looking in the 5s, maybe even the high 5s, depending upon the criteria, but you're not looking at that bad of an interest rate compared to what it would be otherwise. Perfect. All right. Any other questions we have about ways we overcome issues with income? No? Are all the rates fixed? All of the rates are fixed except the doctor loan program. So earlier on, I talked about the doctor loan. That's the only loan that does not offer a fixed rate option. Every other loan is a fixed rates, and none of the loans have a prepayment penalty. They're all fixed rate options. Great question. All right, overcoming issues with property. By the way, guys, if you could do me a huge favor, if you could just post into chat and say hi, because I don't have the ability in Zoom to capture who was here. And so if you've already chatted something, no problem. But if you haven't chatted, if you wouldn't mind just posting in here, and if you're using somebody else's login, tell me who you really are. I just want to be able to track who has shown up today. So just say hi in the chat, and that way the chat log saves for me. The list of participants doesn't, and I don't have the time to write down who you are. Thanks, Michelle. Hi, really, Beth Logue. All right, Penny. Back to the DPA programs. Can any be used to purchase a multi-unit? I hate to use the word any, but in general, no. Down payment assistance programs don't play well with multi-unit properties. They also don't play well with renovation loans. So if somebody has just 3.5% for a down payment, we can do a traditional FHA loan, owner occupied on one of the units, and they can rent out the other 1, 2, or 3 units of an up to 4 unit property. But and again, I can research this if you want me to be 100% sure, but I'm pretty good with my guidelines, and I'm 92.7% sure that none of the down payment assistance programs can be used to purchase multi-unit properties. All right, perfect. Everybody else is just saying hi. Thanks for saying hi. Perfect. Hi, Randy. Hi, Dave. All right, perfect. Thank you. What specific marketing materials you have to market to doctors? I will capture that in the chat, Efrain, and I will get that to you this afternoon. Or excuse me, I won't get it this afternoon. I'll probably get it to you tomorrow. All right, perfect. So let's move on to issues with property. This is the last section that I want to talk about, is how to overcome issues with properties. One of the biggest things we run into is people who are trying to build a real estate portfolio. Now, for you as a realtor, that is an amazing client to capture, because somebody who's building a real estate portfolio, they're going to keep buying and acquiring properties over the years, and it's going to help you to have a repeat client that you don't have to worry about chasing, where's my next deal coming from? You got this person that you can continue to serve over time. The problem is conventional guidelines have limits, the limits to how many properties you're allowed to own. Now, if I have somebody in that situation, we're going to put all the properties into their name using conventional lending. Once we hit 10 financed properties, we cannot buy any more using regular conventional lending. That's when we can fall to these other programs. It gives us more flexibility to add to their portfolio, and it's significantly cheaper than commercial loans. So it offers them kind of residential flexibility without getting to commercial lending and their 30-year fixed rate loans. One other side note, if you have a married couple that is buying investment properties and they're both working, they should buy the properties separately, because each spouse can have 10 properties of their own. They could acquire 20 properties using conventional financing. If they co-own the properties, each property counts towards the maximum of 10 for each of them. But if they own them separate, each property only counts 10 for this person, the next 10 count for this person. They can acquire 20 properties without having to go to these alternative programs. All right, oops, missed the last part. Condominiums. This is one of the biggest areas of opportunity with my new programs. A lot of condominiums have problems with their homeowners association. Fannie Mae, FHA, they all require, as a lender, not only do I approve the borrower, but I have to approve the association. And we're looking for how many people are renters in the complex, how many people are delinquent on their association dues in the complex. We're looking for a lot of things about the complex that concerns the lender, that, man, if the financial health of this complex is compromised, then either A, the homeowners association is going to fall apart and who's going to pay the insurance, or B, the homeowners association dues are going to skyrocket. My client might not be able to afford to pay that, and now I'm going to end up with a foreclosure. That's why you find that there are super cheap condos that say cash buyers only. My programs allow for a buyer to buy a non-warrantable condo, a condo that doesn't meet Fannie Mae and Freddie Mac's guidelines, and they only need to put as little as 20% down. Now, there's times when it has to be more if it's an investment property, et cetera. But if you've got somebody that wants to buy a condo and they have some money for down payment, but they're looking at these cheap condos saying, why can't I buy that one? It says cash. Why can't I use a loan for it? The reason why I just explained, the solution is now available to you as long as they have 20% down. The last thing about property is property condition. I want to remind you that I am fully certified and I have the ability to do renovation lending. Now, renovation lending uses FHA's guidelines. So they have to qualify for an FHA loan. But the cool thing about renovation is when you have that property that says cash only, because the property isn't in good enough condition to make the bank happy, we need to get a contractor in there before we get the appraisal done and get a bid for all the work it's going to take to make the property meet Fannie Mae's guidelines, or FHA's guidelines, I should say. And then we turn around and we get the appraisal done based on what the contractor's work is going to be completed. The buyer purchases the property and the work starts after close of escrow. They're allowed to buy a property even if the property literally was burned down. We could lend you the money to rebuild the property. Now remember, renovation lending is using FHA's guidelines. So a lot of the things I talked about today for forgiveness of income, forgiveness of credit, wouldn't play well with renovation lending because it's not meeting FHA's guidelines. but it is a great way to help somebody who maybe they're trying to, they're trying to find the right home in the right neighborhood, and you can't find that for them. Well, then how about find them the wrong home or the broken home in the right neighborhood? You get them into contract on that home, and we loan them the money to make it the perfect home in the right neighborhood. All right, gang, that is all that I've got. So I ended 20 minutes early. I've got time for questions, so I'll happily hang out here. If you have questions, feel free to post questions into chat or unmute yourself and feel free to chat with me verbally if you have questions. But hopefully this has been valuable. Again, a lot of information here. My goal is not for you to memorize all of it. My goal is really to give you tools to not say no when somebody says I can't, or if a lender says I can't. First of all, you sent it to the wrong lender. You want to get them to me in the first place. But if you happen to make that mistake of sending it to somebody else, you can get them over to me for a second opinion, and I can help them find a way to qualify. So thank you so much. My contact information, absolutely. So first of all, I will post right here. My cell phone number is, oops, I can't type, cell 209-423. My number lock's not working. Cell 209-423-1482. All right, and my email is john@johnloanking.com. Beautiful. All right, Penny, you asked if renovation loans work with multi-units. Absolutely, they do. So renovation loans can go up to a 4-unit property. We can we can remodel all of the units. We can't do mixed use. You can't do commercial, but FHA will lend up to a 4-unit property. And yes, we can do renovation lending on 4-unit properties, or up 1, 2, 3, or 4-unit properties. All right, what other questions you guys have for me? Beautiful, glad to hear it. Anybody else? Bueller? All right, gang. Well, hey, I'm here. You got my cell phone, you got my email. I'm here to serve, and my team and I are ready to take great care of you, great care of your clients. If you just want to pick my brain, feel free to give me a call, and I look forward to being here. If I don't talk to you next week, have a Merry Christmas. And Penny, did I get your text earlier? Probably not. I've been in meetings back to back, but I will give you a holler once we get off the call. Perfect. All right, gang. Merry Christmas. Post in the chat if you want me to get a copy of this, and I will email you a copy of the presentation. And I hope you all have a wonderful day. Bye-bye.